When investing in U.S. stocks, investors often need to keep a portion of liquid funds to seize market opportunities or cover emergency family expenses while seeking returns similar to short-term U.S. Treasury bills. This episode focuses on cash management tools, analyzing their pros, cons, and suitable scenarios. Due to the lack of liquidity caused by term restrictions, certificates of deposit, short-term U.S. Treasury bills, and I-bonds are excluded. We will focus on cash management funds and short-term bond ETFs. First, let's discuss cash management funds. Cash management funds are known for higher liquidity, ideal for investors seeking instant access to funds. For example, Fidelity offers the Fidelity Government Money Market Fund and its advanced version, FZCXX, minimum investment of $100,000, which allows same-day withdrawals. They invest in short-term government securities and repurchase agreements with some income exempt from state taxes, though yields are slightly lower than short-term bond ETFs. And Charles Schwab offers similar products with comparable features. Next, let's explore short-term ETFs. Short-term bond ETFs track 0 to 3 months Treasury indices, offering slightly less liquidity than cash management funds but higher yields. Common options include the first, PIMCO Enhanced Short Maturity Active ETF, high yield and the most popular short-term bond ETF. The second, iShares 0 to 3 months Treasury bond ETF and SPDR Bloomberg 1 to 3 months T-bill ETF, slightly lower yields than MRNT but with strong stability. Then let's address the tax issue. Whether it's SPAXX or MINT, their main drawback is the monthly dividends, subject to up to 30% withholding tax for non-resident aliens holding W8BEN status. For example, investors from China or Japan may enjoy a 10% tax rate. High tax rates significantly reduce after-tax returns. Can avoiding dividends lower the tax burden? Today's start. The BOXX ETF is designed for this purpose. So let's dive into BOXX's origin and tax features. The Alpha Architect 1 to 3 months BOXX ETF was launched on December 27, 2022. As of March 31st, 2025, it has assets under management of $6.471 billion, an annualized return of 5.02%, and a net expense ratio of 0.1949%. It is reduced by 0.05% after discount. BOXX uses a BOXX spread options strategy to replicate 1 to 3 month Treasury yields with comparable risk but significant tax advantages. Its core features include: the first, tax deferral. BOXX avoids regular dividends, accumulating gains as capital appreciation, allowing investors to choose when to sell and defer taxes, reducing annual tax burdens. For high-income earners, federal tax rate of 33% to 37%. This can significantly lower taxes. For example, with a 5% annual return, a 37% ordinary income tax rate, and a 20% capital gains tax rate. Tax deferral can save approximately 17% in after-tax returns. Capital gains tax rate. Under IRS Section 1256, BOXX's S&P 500 index option gains are taxed as 60% long-term capital gains and 40% short-term capital gains, lower than the ordinary income tax rate. And the ETF structure advantage. The ETF's creation and redemption mechanism allows for deferred dividends and the carry forward of certain option contract capital losses, further optimizing tax efficiency. BOXX uses a BOXX spread option strategy to replicate 1 to 3 months Treasury yields. The core mechanism is as follows. The first, strategy structure. BOXX employs S&P 500 index options involving 4 contracts. The first, buy a call option at a $4,000 strike price and sell a put option at the same strike. The second, buy a put option at a $5,000 strike price and sell a call option at the same strike. The third, the combination eliminates market risk, locking in a fixed return, for example, a $1,000 spread. Then zero coupon bond analogy. Investors buy BOXX at a discount, for example, $952 based on a 5% rate, and receive a fixed return at maturity, for example, $1,000, similar to a zero coupon bond. And return source. Returns come from option, premium, and risk-free rates, aiming to match 1 to 3 months Treasury yields. Now, European options. BOXX uses European-style options, exercisable only at expiration, avoiding early exercise risk and ensuring stable returns. Next, BOXX's main risks. Despite being marketed as low risk, BOXX's complexity introduces the following risks. First, tax risk. The IRS may reclassify gains as ordinary income under Section 1258, as BOXX's returns are primarily time value based, similar to a savings account. The prospectus details this conversion transaction risk. Second, counterparty risk. BOXX relies on the options clearing corporation for fulfillment. the OCC's credit rating is comparable to the U.S. government's, making default risk extremely low, but extremely scenarios should be considered. Third, fees. BOXX's net expense ratio of 0.1949% is higher than SGOV and BIL, but lower than MINT and SPAXX. Options trading costs may further reduce returns. Fourth, yield risk. BOXX's returns are tied to 1 to 3 months Treasury yields, so a decline in Treasury yields will lower BOXX's returns. Additionally, the August 2024 dividend event. BOXX's key appeal lies in avoiding dividends through its box spread strategy and heartbeat trades to defer taxes. However, on August 13, 2024, BOXX unexpectedly distributed a $0.29 share dividend, breaking its no dividend promise and triggering unexpected tax liabilities, especially for high-income investors facing short-term capital gains taxed at ordinary income rates up to 37%. This event sparked investor dissatisfaction, likely linked to market volatility in early August 2024. For example, the yen carry trade unwound, causing a VLX spike, resulting in option positions generating residual income that couldn't be offset by heartbeat trades, forcing BOXX to distribute capital gains. So, is BOXX worth investing in? BOXX offers low-risk returns similar to Treasuries with tax optimization through its innovative box spread strategy, making it particularly suitable for higher-income earners managing cash. However, its complexity and risks, for example, tax reclassification, unexpected dividends due to market volatility, require careful consideration. Investment recommendations are as follows. First, high-income earners. Prioritize BOXX for significant tax deferral benefits, ideal for holding periods over 1 year to leverage long-term capital gains risks. Second, high liquidity needs. Choose SPAXX for same-day access suitable for short-term cash needs. Third, high-yield seekers unfazed by taxes. For MINT for higher yields, ideal for those unbothered by monthly dividend taxes. BOXX's innovation is impressive, but its tax advantages depend on individual tax rates and investment horizons. What are your thoughts on BOXX? Please share them in the comments.